All right, everyone, my clock says it's noon, so I think we are going to go ahead and get started. I'm Heidi Garvin with Grow Nebraska, and I'd like to welcome all of you to our third Thursday training. So, for those of you who don't know, every Thursday, third Thursday of the month, we host a free training webinar. You can learn more about these at grownebraska.org. It's under our trainings tab, and you can find out about all of our wonderful trainings there. But our third Thursday trainings are always free and open to the public. So I'd like to thank all of you for joining in on this one. On that page, you can also learn about our annual Market Tech Conference in Kearney. It's going to be on March 15th this year, and we're super excited. We are bringing in some amazing national speakers, including Jen Herman, who is an Instagram guru out of San Diego, and Maria Elena Duran, who's flying in from Texas. She is a Google expert. We also have an amazing Google training series that we're going to be putting on over the next few months here that you can learn about on that page. We also have exclusive trainings for Grow Nebraska members. Our March training, it's going to be on the first Friday in March from noon to 1, and that one is going to teach you how to master selling online. So if you are a Grow Nebraska member, I highly encourage you to sign up for these. Then you are all also invited to our annual open house at the Nebraska State Capitol. So this is going to be on February 22nd in room 1023. So if you want to network with other amazing Nebraska business owners, this is a great opportunity for you to come, hang out, try some light refreshments, and see how innovative Nebraskans are being. So it's going to be a great event. We are also celebrating 20 years at Grow Nebraska. We invite you to join in the celebration. You can learn more about how we're celebrating by following us on social media. So go on like our Facebook page. Not only will you get up-to-date updates about trainings like these, but you'll also get to celebrate Nebraska businesses with us. And now, the reason we're all here, we'll finally get started. I am going to unmute for a moment. Deb, can you?
Yes, I'm here.
Perfect. Okay, we can hear you. So these trainings, we keep them free and open to the public, but this would not be possible without the help of our amazing sponsors. So today we have Deb Andrews on the line, and she is going to tell us a little bit about this month's sponsor, First State Bank Community Bank.
Okay, well, thank you. I'll just take a moment here of your time. I just wanted to mention, as a sponsor of today's webinar, I just wanted to take the opportunity to thank you for attending, and also just to introduce you to our bank. We are a community bank, a division of First State Bank. Community Bank is located in Alma and Stanford, Nebraska, but we also have 3 other locations that are known simply as First State Bank. And they're in Farnham, Holbrook, and Cambridge, Nebraska. So basically, we have 2 names and 5 locations. But all of our locations encourage local growth, and we do strive to help new businesses in our areas get up and get going. For our new business customers, we offer operating lines of credit, intermediate term loans, and long-term real estate loans. We also have partnered with local companies that also encourage local growth, like as an example, Twin Valleys Public Power. They occasionally have low interest loans available for new business owners. And together we've partnered with them to help a local customer obtain the real estate loan that they needed. Plus we were able to do operating funds needed to get them up and going. We've also partnered with the Small Business Administration and have done quite a few of those loans for our local people. We'd love to have the opportunity to work with you. So if there's anything that we can do to assist, feel free to contact any of our branches and see what we can do. Thanks for today's, and you guys have a great day.
Yeah, thank you, Deb. And for those of you who haven't worked with Community Bank before, they are amazing people to work with. So check them out. We will be sending a link to their website in our follow-up email. I'll also be sending out a recording of this presentation. So if you are trying to take notes and you feel like we're just going a little too fast, you can always go back and review that recording afterward. So I will be sending that out along with the survey following the training. But now, the reason we are all here, we have Ben Williamson on the line with Invest Nebraska. So Ben, I'm going to let you take over the screen.
All righty. Hi, everybody. My name is Ben Williamson. I want to thank, first of all, Heidi and then Deb as well for this training, this third Thursday training. I'm excited to be here and do this webinar. I am an associate with Invest Nebraska Corporation, and I will get into what that means a little bit more here shortly. Today's presentation is titled, and I guess subject matter is Raising Capital with Nebraska's Angel Investors. So to start, just to provide a little bit of useful background information, I thought I would discuss what Invest Nebraska is and our relationship to angel investors in the state. Invest Nebraska is a nonprofit venture development company fund from the state of Nebraska. And what that means is, among other things, we invest in high growth companies in the state of Nebraska, and most of the funding for that pursuit comes from the state of Nebraska. While investing in these companies, you see a couple bullet points there of, I guess, requirements or constraints that we do and don't follow. And the first one being that the typical investment that we make in a startup company is anywhere from $125,000 to $250,000 typically. And the total amount that we can invest in any one company is generally $500,000. As far as the types of industries that we like to invest in, we're completely industry agnostic, which obviously means that we don't have a preference to any different industry. And in fact, we prefer and enjoy to keep our portfolio diversified and would like to have every industry represented if possible. The next bullet there says lead and follow. That simply means that we will either lead the investments, acting as kind of the point of contact for all the other investors, whether that be negotiating with the company or simply just organizing the investment, or we'll follow along if someone else takes that role, whether in the state of Nebraska or outside the state of Nebraska. As I implied by saying we could invest up to $500,000 in each company, that means that we'll do typically a first investment of between $125 to $250, and then somewhere down the line, a company may need to raise money again, and we would certainly help in that. But we would also like to participate again and invest again to continue to support that company. That's where the total number comes in there. And as far as financing options, types of funding, we will get a little more into this later also. But as far as investments go, when we're talking about high growth startup companies, the two typical types of investments are either preferred equity investments, or the alternative would be convertible note investments, which are similar except for that they operate as debt at the beginning. Ultimately, the goal is to be converted into equity, just like the preferred equity begins. So those are the two main types. For companies that may not fit into the high growth mold, we also have types of loans in our microloan program to provide for companies as well that may not want to take equity that would dilute their ownership of the company. The last bullet point there is very significant and very relevant to today's presentation, and that is, although Invest Nebraska technically is not an angel investor for reasons you'll see in a bit, we often invest at the same time as and alongside angel investors and work closely with angel investors. And so that opens up a lot of opportunities for Invest Nebraska and gives us insight in this area. Next, I thought it would be helpful to provide just a little background on venture capital or angel capital generally. And I guess the basic definition or general high level view there is just the capital is financial capital provided to early stage, high potential, high risk startup growth companies. Obviously, that is not every company that is a startup company or a small business, but there is a subset of those companies that fit into that mold and are appropriate to take on venture angel capital. The next bullet point there goes a little bit more in depth and explains that because these investments are higher risk, the angels or the venture capitalists usually invest in very early companies, and therefore you would anticipate getting a little bit higher percentage of ownership in order to justify the risk that these angel investors or venture capitalists are taking in the company. So that's just a little bit background information that most people probably know, but it's worth discussing before we move on. Now, this is an interesting graphic that we have here, and it is relevant for a couple of reasons. From an Invest Nebraska standpoint, the reason that the program exists as it does today comes from 2011. There was an act called the Business Innovation Act that was passed in Nebraska. Without getting too much into detail about the act, it essentially enabled funds to be allocated to different programs in the state of Nebraska, some grant programs and then some investment programs, which is the program that Invest Nebraska runs, that incentivized and provided money to invest in startups in the state. You'll see in this graphic here, this is aggregated dollars invested in startup companies in the state, in every state. And the first column there on the left is from 2011. You'll see that Nebraska is tied for dead last as far as investment dollars go. So in large part because of companies like Invest Nebraska, private companies, angel investors. Over the years from 2011 on, you'll see that from 2014 until last year even, Nebraska is closer to the middle of that group. And in fact, we anticipate that 2018 will be even higher than we were in 2017. So that's an interesting graphic that just shows that this Business Innovation Act and some of the programs that the state of Nebraska has put in place are actually sort of progressive and match some of the programs you often see on the East Coast. And it is actually making a difference in the amount of money being invested in these startup companies, trying to help them succeed and incentivize entrepreneurs to start companies when they otherwise might not. Again, a little bit of a basic and maybe obvious definition, but some people may not know, is just who are angel investors. And angel investors are obviously individuals that provide capital to one or more startup companies. Obviously, that's one reason why Invest Nebraska isn't technically an angel investor, because we're a company and not an individual. But as I mentioned, we invest alongside of angel investors and at the same stage as angel investors. Oftentimes, you'll find that angel investors were former entrepreneurs and have experience in that certain sector. So angel investors are especially valuable because they can add that value to the entrepreneur, to their business, where they have a certain expertise. Maybe they've started a company and ultimately sold the company, which is where they acquired their wealth, or merely worked in an industry for a lot of years successfully and have insights and expertise that they can share with that entrepreneur, that founder, that team. On the right side there, you see a little more nuanced definition. Because of the securities laws and regulations, it's necessary that generally angel investors are qualified as accredited investors, which means those three bullet points there. You have $1 million in net worth, $200,000 annual income within the last 2 years, and $300,000 annual income jointly with your spouse. Next, what are angel groups? And again, this may be a little bit obvious, but this is something that before I got into the industry, I didn't really know existed in the state of Nebraska. So angel groups are obviously networks of angel investors who work together to do several things. The most important or most obvious of which is to find and review deals. So it's easier to get people to come present deals to you if you have a group of angels willing to invest rather than just one person. Additionally, they would conduct due diligence together, which includes all of those things, among other things. They would negotiate the terms of the investment together. Obviously, different angels bring to the table different types of expertise, and there's often people that have expertise in negotiating deals, and that becomes very important when having those conversations with the companies. And perhaps most importantly, angel groups do a great job of pooling insights, pooling ideas, connections, expertise, and other resources. Obviously, when you have a lot of people in the room that are interested in investing in companies and have the wealth to do so, but also want to give back and provide value to these companies, you can take advantage of a lot of those connections and things that come from that. So the next bullet point there, the next main bullet point is, although it's a group of angel investors, the members still decide individually whether or not they would like to invest in the company. You could potentially have a company that goes to an angel group and only has one angel invest. Oftentimes, though, you see a handful of angels that tend to invest in most of the deals, so that would be probably pretty rare. As far as angel groups locally or in the state of Nebraska, the most prevalent is the Nebraska Angels, and that's a group that is based primarily out of Lincoln and Omaha. You don't have to be from Lincoln and Omaha, but that's where the meetings take place. So that's where you see most of the concentration of the members there. And that's a group that has monthly meetings, that hears pitches from companies, and does quite a few investments every year. There's also a group out of Norfolk that Invest Nebraska helped start, and that's a group of about 8 or 10 investors up in that area that are interested in reviewing deals. They don't have regular meetings necessarily, but they invest whenever deals come to their attention. And it's a situation where Invest Nebraska or the Nebraska Angels or other investors in the state would share deals between the Northeast Angels group and vice versa. There are similar groups to the Northeast Angels that have begun to start and begin to gather interest in the Hastings and the Beatrice areas in Nebraska. So it's really kind of cool to see these different groups popping up across the state where investors are becoming interested in working with early stage startup companies. This is another interesting graphic, and the next page will shed some light as well, but it answers the main question: when do angels typically invest in these companies? And the first bullet there, it is very common that angels invest in companies that have just passed the prototype or the MVP, which stands for minimum viable product or prototype phase. Obviously, this stage can vary by industry. An easy example of that is a medical device, for example, may need to raise a bunch of money prior to developing a prototype or prior to going through FDA or certain clinical approvals. So specific industries do have a little bit of nuance to them, but typically the investment comes in what is known as, not so endearingly, the valley of death stage, as you see in that graphic. What that means is entrepreneurs often get to a point where they've created a prototype, they're ready to try to go out and get customers, but they need money to get traction and to go ahead and do that. And then you have the investors on the other side of the table saying, that's great, but you need to get that traction before we'll give you the money. So they come to a bit of an impasse where it's hard to get funds in that area, right past the prototype stage before commercialization. And so that's a stage when you typically see angels come into the picture. You'll see at the bottom there, it says typical primary investors, and that shows the different groups that often come in and invest in those stages. The first being government, meaning investments not in the traditional sense, but more in the sense of grants and different programs that governments run. The next being where you see angel investors and also Invest Nebraska. And this graphic is essentially saying the exact same thing, but in a little bit of a different arrangement there. So you see up top, you see just past the prototype stage, we get into what is known as the seed stage. And that's often where you see angels and other groups that are interested in very early startups fill that void. As mentioned, we invest alongside angel investors at that stage and sort of operate alongside those angel investors. So now we will talk a little bit about why angels invest, what the upside is for angels to invest. This may not seem completely relevant to people who aren't interested in being angel investors. But if you are anyone who wants to start up a company or be an entrepreneur, start a small business, I think it's important to see the other side of the table and remember why angels might be doing this, so you can cater to those interests of the angel investors. The first bullet point here is maybe obvious, but some people may look past it. Obviously, anyone who's defined as an investor, by definition, they are looking for some type of economic return on their investment. So the first bullet there shows that multiple studies have shown over the long run, carefully selected and managed portfolios can produce a pretty healthy return. And obviously that return is one that over time performs much better than the stock market or frankly any other type of debt instrument or investment. The bold language there is intentionally bolded because it is the most important language and often forgotten by even angel investors, that they must keep in mind it is for the long run, must be carefully selected and managed. And that goes back to talk about things like diversification of a portfolio or simply making enough investments to get that type of return. I'll go kind of quickly through the other ones, again, as they may be a little obvious, but being involved as an owner of a startup obviously is fun and rewarding. That's why one of the reasons that entrepreneurs do it. It's also a good way for angels to provide value to these companies, provide connections to these companies, and kind of give back to their communities, to their ecosystems that they have probably succeeded in. So giving their money to a company who is in desperate need of money and maybe direction is kind of the social give back factor. And it's exciting as well. It gives them the opportunity to be part of the startup without being on the front lines. Again, kind of in the same vein, the opportunity to advise and mentor as a company changes and develops and grows is exciting as well. And it's fun to see and be a part of. Next, to be part of the technology, the next big thing, and to keep up with the world. This an example that might be relevant today would be something like virtual reality or augmented reality that a couple years ago tried to come out and had a lot of companies trying their hand in that, and it might have appeared that the technology was too early, but that's something that is on the cutting edge that angel and venture capitalists have the opportunity to be involved with and learn about and have some expertise in because they're involved in these startup companies. Obviously, the next, to help train future leaders, to build communities, to create jobs, diversify wealth, diversify the economy, grow business, and very importantly, perhaps most importantly, to encourage entrepreneurship, to build the ecosystem, and then to help these companies go out and raise additional money. Oftentimes in the state of Nebraska, you'll see that angels and Invest Nebraska may get involved very early in these companies, and they go on to raise incredible amounts of money, both from in-state and out of the state of Nebraska, and bring that money back to Nebraska and put it to work. And the last point is one that I already mentioned. It's great to collaborate with the other angels and gain the insight, expertise, connections, and those types of things. Next, what are angels looking for? And these are important, and again, maybe a little obvious and sound easy, but the first being a strong founder. All of those characteristics that I've listed below are ones that are especially relevant for startup entrepreneurs. Next, a product in the market, or at least a finished prototype, a strong team assembled, at least the key management or key employees, a well-crafted financial plan, and a clear and detailed pitch and supporting materials. Sounds very easy. It's not always so easy in practice. You'll notice one thing that is not included on this list is a good idea. And that is for two reasons. The first reason being, having a good idea is sort of cost of doing business. I think that's what gets you in the door a lot of times, is a good idea. And for another reason is often people focus too much on the idea, and the idea isn't necessarily what matters in a startup with an entrepreneur. This next graphic is one that I really like that sort of illustrates that fact. And it's placing the emphasis on the actual execution rather than the idea. it says their ideas are worth nothing unless executed. They're just a multiplier. So to make a business, you need to multiply the two columns, the idea against the execution. So you'll see that even the most brilliant idea with no execution is only worth $20. So oftentimes you see entrepreneurs that are putting too much focus on the idea and not enough focus on how to make it happen. Next, we will go through a bunch of different steps on how to actually secure angel capital, what those steps look like, and some practical advice along the way. So obviously, as I pointed out in those earlier slides and graphics, venture capital and angel capital are typically not the first form of funding that comes into a business. It's often one of the later sources of funding, even though it's still quote unquote early stage. Oftentimes, things that companies will do first before they seek outside capital is bootstrap the business, which simply means they run the business with as few expenses as possible without taking salaries, maybe partnering with service providers or people who have a certain expertise, whether it's technology or sales or something, where they get a portion of equity in the company rather than getting paid a salary. This is your stereotypical build Facebook out of your garage or out of your basement bootstrapping, and it shows the team's commitment to investors. It's nice to see the team that has bootstrapped their business for a while before they try to seek outside investment. The next category is the friends, family, and fools category, and that's a little bit of a tongue-in-cheek title, but oftentimes entrepreneurs and startups will seek money from people around them in order to try to get off the ground and gain some traction, again, without diluting equity or taking on too much outside capital. And it's an underrated source for money. If the way an investor sort of looks at it is if a company has a hard time convincing your friends and family that they should invest money, then why should the investor invest money? That is one way that the investor might look at that. But we also see lots of companies that are able to get quite a bit of capital and gain a lot of traction and figure a lot of things out before going and getting outside funds, and that's really important as well. The last bullet point there is very important, and it's something that we discuss with companies all the time, and it's a distinction between a quote-unquote lifestyle company and a quote-unquote high-growth company. And both approaches are completely and 100% valid approaches of running a business. But one approach caters itself to taking on outside investment to try to grow quickly, where the other doesn't necessarily cater to doing that. Obviously, the lifestyle company implies that this is a company that you may run for your entire life and simply make money and live off of that company. Again, a perfectly valid way to run a company. However, from an investment standpoint, whether it's an angel, venture capitalist, or otherwise, it may not be wise for someone who wants to run a lifestyle company to take on investment where you're going to give up some equity in your company. And ultimately, when you give up equity, you give up a little bit of control of the company. So that could hurt the company in ways that you need to kind of think about and make that decision which way you want to pursue. So that's obviously the first step, just determining whether outside money is even appropriate at that time, and frankly, trying to get some organic money to figure things out before pursuing outside capital. The next step is to find the right angels or the right angel group. And part of this is trying to figure out what types of companies they like to invest in. The first bullet point there, stage focus. So typically, if, for example, your company has not yet started making any revenue, you would want to find an angel group that is comfortable with and has in the past invested in companies that are quote-unquote pre-revenue, have not made money yet. Otherwise, it's simply not going to be a good fit, and it will be a waste of your time. Some other factors, geographic focus, industry focus, size of investment criteria, most of those are pretty self-explanatory. I would think that most angel groups don't have a very strict geographic focus. It probably is not necessarily in their best interest to limit the investments they hear to maybe the state that they're in. An exception could be some angel groups out in California that have so much deal flow from the state, they may not usher in or try to attract outside companies. As far as locally, for the most part, the Nebraska Angels at least do not have any requirement that it has to be a Nebraska company. But I think that all of the angel groups in Nebraska have a preference for Nebraska companies because they want to invest in companies in the state. They want to keep their money in the state, keep creating jobs in the state, and that type of thing. The next bullet point is another important one, return on investment criteria. And frankly, this one is a little sensitive for some entrepreneurs. But what it basically is saying is most investors, angel investors and otherwise, have a criteria in their head that they want to return, the amount they want to return on their investment. So for that, you can kind of reverse engineer and figure out whether it's an appropriate investment for you. For example, if an angel investor knows how much they're going to invest and they know what their return on investment criteria is, let's say, for example, it's a 5 times multiple of their original investment, and they think they can guess how much your company will ultimately sell for in a best case scenario, they can figure out what percentage of the company they need to own in order to get that desired return. Oftentimes that could disqualify a company right off the bat if they're asking for too high of a valuation that doesn't allow the angel to even have a shot at their desired return. So that's something good to always think about. The last one's also very important, is the investment style. There are definitely some angels out there that have the expertise and they really like to take a hands-on approach and help the company, whether it's providing know-how or providing connections. Some angels simply like to invest and then not do anything with the company except for get their periodic updates. It's good to know what types of angels you're dealing with so you can anticipate whether that capital is appropriate for you to take, and to dictate how you proceed with your company after taking the investment. Third is to prepare a business plan. So the bullet points here, again, are relatively self-explanatory. Obviously, investors are trying to gather as much information as they can about any particular company. It helps to lead with a summary, but then go through and actually explain things out, like your company's advantage in the market, what the market looks like, how large the market is, and provide any analysis you might have, your plan of attack for the next couple of years. And also, it's a good place for you to highlight the team that you have in place to prove that ever important point I mentioned before, the execution and how you're going to actually execute on your idea, on your goal, and on your financial projections. A lot of times, angel investors or other investors would expect your business plan to be in excess of 20 pages. There are a lot of business sources out there that advocate for the 2-page business plan, and I think those are fantastic for internal uses to get everybody in a company rowing the same direction and on the same page. However, as I mentioned, investors want to get as much information as possible, and putting the time in and thinking about developing a long-form business plan benefits you in an investment scenario. There are actually companies that we've seen where companies have had the 2 or 4 page business plan, and that was probably a major reason that that company did not go on to secure an investment. As I mentioned before, again, focus on your team, your management team, and your key employees. Angels and other investors want to invest in teams over ideas. The team is ultimately who's going to take you to execution, and so that's important to focus. It gives you an opportunity to sell yourself, sell your team, and focus on the advantages that you guys have and bring to the table. Another good thing with the market is to think about how your business is going to change the current market and where you see the market going over the next 5 years. The angel investment or startup investment game is a long-term game. And although all angels would love to get their money back in 3 years, realistically, it usually takes at least 5 before anything happens. So showing that you have that vision of where the market and the business will change is also very helpful. And a business plan is a really easy and nice way to show that you have thought about that and prepared for that. Also, feel free to ask for help from anyone that you know involved in investing or business at all. It never hurts to ask for help with a business plan. Have someone read over your business plan, someone like myself or any angels you might know. I think almost everybody, especially in the state of Nebraska, would be super great about reviewing and providing feedback and notes and that type of thing. Number 4 is to make a powerful presentation to the angel or the venture capitalist. This is obviously known as the pitch, and it's something where a founder, again, has an opportunity to kind of showcase their strengths and really focus on the things that are advantageous to that company over the rest of the market or over competitors and things like that. Some important points: get to the point. This is not where you read through your whole 20-page business plan. It's where you show your highlights and go through the kind of main points of what you want the angel or the investor to take away. Focus on the market opportunity. In today's market, technology is necessary, but just having technology is not enough. Guide the presentation towards the management, towards the market, and show where the money ultimately follows. And the next one, again, a little tongue-in-cheek, but when doing a pitch, the angels typically have short attention spans, so they want to hear the idea, hear the main points, and then have the ability to ask questions and dig deeper where necessary. Next, as I've already mentioned, find strong, seasoned managers and team. Demonstrate a very large future market opportunity. That's something the angels want to see. And show escalating barriers to entry in your market. And what this means is that show that after you enter the market, it's going to be very hard for a competitor to come in and essentially copy what you're doing. That's important and often overlooked by people when making pitches. Sometimes investors, including angel investors, will recommend you do a 10-20-30 rule, which means 10 PowerPoint slides, 20 minutes, 30-point font. And the concept there is to imply that you should be able to explain your business inside those constraints. And if you're able to do that, it reflects well on you as a founder. The next category here is understand the valuation process and determine an exit strategy. This is something I sort of alluded to a little bit when I was referencing the valuation requirements for any angel, or the return on their investment requirements. But one of the things that every investor is going to be thinking about from the very beginning is what the end game looks like, what the exit looks like for this company, and how they're going to ultimately get their desired return on their money. Again, this is where it's important that you have decided that you want your company to be a quote-unquote high-growth company instead of a lifestyle company. If you get into a situation where you want to run a lifestyle company and you have someone that owns equity in your business, at that point, your interests are no longer aligned as soon as the investor wants you to somehow sell your company or exit your company and you want to continue running it. Obviously, if you are taking on the outside investment, that's why being a high growth company with an exit in mind is an essential factor. So you want to identify the major risks in your business, again, over the next couple of years, reduce the perceived risks to achieve the increased value in your company ultimately. And again, understand the investor's return on investment criteria. And this may be more difficult to do when you have angel investors and you have several investing at the same time. It may be a little easier when you have just a few firms investing. But either way, this is where angel groups can work together to communicate some of those things. But the most important thing is to be able to show that you and your team has thought about where the company is going to go and what the end game is. That's the most important thing that investors want to see. What is your exit strategy? And there are several methods. Without getting too far in the weeds today, There are several methods that angel investors, venture capital investors, and other investors use to value companies. It's even harder to do valuation analysis for startup companies because of so many unknowns and a lack of financial history, if you will. But a lot of times, if you are in a certain industry, angel investors and other investors might do things as simple as comparing your company to other companies that have exited or been purchased or merged with a bigger company in the past. And that's an easy way to get a sense of where the company's going and what the exit might look like. There are so many factors involved with that, like your market, your team, the risks involved, how far along your company is, how healthy your company is, what your product looks like, and all of these things that it's really hard to nail down one method that a company should use. But a company should be familiar with different types of valuation that investors might use in order to properly get their exit strategy in mind and convey that to the investors. The last step I have here is due diligence. And this is simply the process of learning everything about a potential portfolio company, so a potential investment, anything from business structure, financials, taxes, legal issues, employees, contracts signed, regulations, patents, intellectual property, anything like that, and much more. As a founder, as a company, as an entrepreneur, you should be gathering information and digging and doing due diligence on your investors. And just as you're doing that, obviously the investors are going to be doing the same for your company, which ultimately is a good thing for both parties. This can be a very long process, and this is something that is often underestimated by investors. In fact, the fundraising process as a whole is often underestimated by entrepreneurs and companies. It tends to be a full-time job, and the due diligence process alone can consist of several phone calls, multiple meetings, lots of emails back and forth, sending everything from your pitch deck to your business plan to your financials to your projections, and it can be fairly onerous. So when you go out to decide that you would like to raise outside capital, it's good to just be prepared that it might take longer than you expect, it might take more time than you expect, and it simply may be a bigger process than you expect, and you may have to make sure your business is still able to run in the background. So practically speaking, how could you apply for angel investment in the state of Nebraska? I mentioned that the most prevalent angel group is the Nebraska Angels, and they use, obviously word of mouth is probably the number one way connections are made, introductions are made. Nebraska Angels also uses a platform called Gus, which is an online angel platform where a company or an entrepreneur can go on there and create a company profile and can apply out to as many angel groups across the country as they want, or they could just apply to their state's angel groups and simply do things like provide all of the details about your company's team, maybe what the structure, the legal structure and the cap table, the capitalization, if you've taken on previous money, what that looks like. It allows you to upload your pitch deck, your PowerPoint. It allows you to upload any documents that you deem relevant. But that is a good and easy way for companies to apply. If a company applies to that program and is of interest to the director, then that discussion would move forward and they would have an opportunity to come present in front of that group. Alternatively, I've left my contact information there. If anyone would like to reach out with questions or would like to be introduced to anyone, I'm happy to do that. And I'm happy to answer questions with respect to angel investing, Invest Nebraska, some combination of the two, or just fundraising in general and what that looks like. Taking a bit of a step back, if you've heard a lot of the things that I've said and you've just decided maybe I'm not quite ready to go out and acquire additional third-party outside capital, The state of Nebraska has several awesome options for companies that are very, very early on, or companies that may want to pursue resources that, again, I've said this a couple times, are not dilutive. And what I mean by that is you don't give up equity in your company, which could detrimentally affect you in the future. The first one I listed here is called NMotion Accelerator. It's an accelerator in Lincoln, and accelerators are typically programs that last usually around 90 days, where companies sign up, they come in, and they receive basically accelerated teaching from faculty and business people locally that can come in and help the company define their vision, to learn things that they may not have had the chance to learn out in the market yet, to do sorts of things like market validation, and really just clarifying where you want to go as a company. InMotion is a great opportunity for many companies, and we've ultimately invested in many InMotion companies after they've graduated from the InMotion program. So I highly recommend that. There's tons of information online there. Otherwise, feel free to reach out to me for that as well. The next is called the Startup Collaborative, and that is in Omaha, and it's kind of a hybrid accelerator and incubator. So that means that they don't follow the 90-day approach of the typical accelerator like InMotion does. Instead, they like to take companies back to square one and really break things down on a granular level and make sure that you have taken every single step along the way, and haven't skipped ahead or jumped ahead too far, where you waste a lot of time and resources going in a direction that isn't the best or the most efficient direction for you to go. And that is something that has, over the last year, really developed and grown, and they're doing a great job attracting a lot of companies and helping a lot of companies. So again, something worth looking into. Additionally, there are some state programs, which I alluded to. Part of the money that came from the Business Innovation Act years ago was allocated to the State of Nebraska grant program, which is also run by the State of Nebraska Department of Economic Development. And the most typical grant that you see available to startup companies is called the Prototype Grant. And the average grant awarded is $50,000, and the goal is to assist with a new product, a new prototype, new technology development. That is a matching reimbursement grant, meaning you must have 33% of the total amount of money you plan to spend. So, for example, if you want to get a $50,000 grant, you would need to have $25,000 in the bank so you could spend money and then be reimbursed by the state. This is a great program that has helped hundreds of companies over the last few years, and is relatively accessible and easy, at least as far as the application process goes. The people at DED and that run the program are very, very approachable and would love to have further conversations with anyone. I have plenty of information on that as well. Again, don't hesitate to ask about that. And the final is there are plenty of federal Small Business Association grants. Obviously, because they're federal grants, they may be a little harder to apply for, simply because there are more people applying for these grants. There are several Nebraska companies, though, over the last few years that have succeeded in acquiring one of these grants, and the state of Nebraska also has some matching grant programs available in the event a company goes out and gets one of these federal grants. So these are just some other options for companies that decide they either may want to operate as a lifestyle company or simply may not be ready yet to take on outside investment. And again, my contact information one more time, and I would love to answer any questions that anyone has about anything I said today, or generally about angel investing or Invest Nebraska or anything along those lines. So thank you.
Awesome. Thank you, Ben. That's tons of great information. And I will be sending out your email address to everybody following the presentation as well.
Perfect.
Right off the bat, I get this question all the time. How much equity should people be prepared to give up if they want to work with an angel investor? Like, when you're going into it, what kind of range do you see?
That is a great question, and one that unfortunately is not necessarily a science, but there are a few definite takeaways and pieces of advice that I would give with respect to that. And that is, most of the time when a company decides that they're going to be a high growth company and decides to take on investment, it is very rare that you would only go raise money one time. Meaning, you may go to an angel group seeking, for example, let's say $200,000. Oftentimes you'll see a company do that, and then a year later they decide they need to scale again and they'll go raise more money. So when you're thinking about being diluted and how much you might be diluted, you need to make sure you think about the fact that there will likely be, probably or perhaps or likely be, additional rounds of investment. So oftentimes the answer, unfortunately, is you will probably be diluted more than you want to be diluted. And another way to answer that question is that, as I mentioned, oftentimes when companies begin and quote unquote bootstrap their business, one of the useful tools that they use, and one that's often, frankly, good to see from an investment side, is founders will often bring in co-founders to provide services and add value to their business. And again, without having to pay salary, you may give up a portion of your business. As a general rule, investors, including angels, like to invest in teams, not individual founders. For obvious reasons, the more perspective, the more experience, the more of that you have on a team, the better it looks for an investor. As far as that goes. So it's useful oftentimes for a founder who had the initial idea to give up some portion of equity to other employees or other managers. To that same end, and I could talk about this probably forever, but to that same end, oftentimes what you see in startup companies is something called an option pool. And that's something that often investors will require a company to establish. And the reason for that is, and honestly, their interests are aligned with the founder's interests, in that they want you to be able to incentivize your key employees to stick around. Because oftentimes in the first couple of years of a startup, you're unable to pay I won't say livable, but a salary that they might expect from another job. So oftentimes you have to incentivize these people by giving out some equity of your company. So it's not rare. In fact, it's very common to see either investors require or founders will just do it automatically and establish typically about a 15%. It could be 10, it could be 20, but I would say maybe an average is a 15% option pool. So that means even if you are an individual founder, basically from day one, you are down to 85% ownership before you even take on any additional investment. There's some legal nuance with options, and technically they don't exist until you grant them. But so because of options, because of additional rounds of funding, oftentimes if you plan to take your startup from day one all the way to the point where you will get an exit, it would be very likely that your ownership would be below 50% certainly, and much lower than you would like. Unfortunately, that's sort of the nature of the beast. And ultimately, if you achieve the type of return that you're going for, you still would be obviously handsomely rewarded. But that is definitely something that you need to think about before taking on outside funding.
Got it. And kind of building off of that, you talked a bit about the due diligence segment.
Yeah.
Where investors will obviously be doing their due diligence to follow up on you. What would you recommend as a business owner we do for our due diligence looking into investors?
That's another great question, and one that is maybe simple to answer in a couple of ways. So there was a slide previously back that listed a couple things that you should look for angel investors, and that's simply things like preferences. Whether it's like what their industry experience is, for example, is an easy one. You want investors on your team that have experience in your industry. Now, not every investor is going to have that, but it's a huge help for you as a company to have somebody that could potentially sit on your board of directors someday and provide you actual value to your company. So simply finding out where the expertise lies in a group of angels would be fantastic. A very easy example of that is if you have a life sciences product, so anything that has to do with health, basically, you would maybe want to target angels that have been doctors for 20 or 30 years and now have turned to investing. That's something that's very common, but those are the types of angels you would want to have a preference for, because they can help make connections and actually help you break into parts of the market you haven't been able to get into yet, and really actually help you scale without, not from the monetary side, but from the operational side. Another easy one is, especially in the state of Nebraska, because oftentimes you'll see the same angels or the same groups or same private companies that do the investing time and time again. So it's a really good resource just to find somebody that's taken on investment in the past and simply ask them what their experience was like with a particular investor. They will be able to give you insight as to whether they were great to work with, whether their vision was aligned with the company, or whether they were came in and tried to be tough negotiators and really either hurt the process or somehow made things less fun for the founder and the entrepreneur. And oftentimes you'll find that other founders and other startups and entrepreneurs will freely share that information because they don't want, if they had a bad experience, they won't want someone else to go through that same thing. So that perhaps is the most useful thing to do is simply ask around in your ecosystem, in your groups that you're involved in with your connections, to get feedback on what investors have been good to work with and which haven't. I would say those are two very good places to start.
Awesome. Thank you. We've only got a few minutes left here, so I do have one more question if nobody else has any, but I'm going to unmute everybody in case somebody has a question.
I always will. Thank you very much.
Well, we will see. All right, so I don't think we're getting any more questions in. So Ben, my last question for you is, can you tell us a little bit about Nebraska businesses who have been successful with this? And I understand if you can't use names, but...
Absolutely. Well, there have been a lot. And the exciting thing is, as I mentioned and showed in that very first graphic, is that Nebraska really did not get involved in the startup investment scene until basically 2012. So we are relatively new to the game. And like I mentioned, most angels and venture capital firms kind of view investments as a 5 to 10 year timeline before you're going to achieve some sort of exit. However, in Nebraska, we have had several companies, and maybe one of the easiest stats to talk about is the amount of money that companies have gone on to raise after they've got either capital from angels or groups like Invest Nebraska, or taking grant money. And there was an economic impact study that was done, commissioned by the state in the middle of 2016. And what they found was, for every dollar of capital that a company has taken from someone like Invest Nebraska or from the grant program or companies or investors like that, they've gone on to raise almost $7 more for each dollar from outside sources, whether that's additional people in the state of Nebraska or maybe more importantly, bringing money from outside the state into Nebraska. So without naming names, we have several companies that have maybe started out raising $250,000 or $500,000 and have gone on to raise rounds of funding of up to $18 million was one recently that if you Google, you can find the name of that from some international organizations. There have been a couple companies that have exited no companies recently that we've been involved with that have sold their company to anyone, but there's been Nathan Preheim, who runs the Startup Collaborative, was part of a company that ultimately moved to Silicon Valley, but started in Nebraska, and they exited, and then he came back to try to help companies do the same thing. You see companies, maybe an easy example is a company like Huddle, who started, with nothing and then went on to raise almost $100 million in funding, and now is doing amazing things, both in Lincoln and in the state of Nebraska. And really some impressive stories as far as Nebraska businesses go of companies that haven't raised outside funding, that are doing really, really, really well and really impressive. So there's something to be said for companies that are able to figure out where they want to go and gain some traction without taking on outside investment. But there are tons of examples. We, in the last 2 years, had a company relocate actually from Silicon Valley to Nebraska, because we have great partnerships with the University of Nebraska. We have, obviously, it's cheaper to start and run a business in Nebraska than some other places in the country, but because of the support that investors and the state of Nebraska and other programs are giving to startup companies, it's making Nebraska a more attractive place to come do business. So there's a lot of success stories, and hopefully we see a few more big ones over the next, even 1 to 2 years.
Awesome. That is wonderful to hear. Well, Ben, thank you so much for this amazing training today. Tons of great information. And I do want to give another shout out to our amazing sponsor who helped us provide this training for free and to keep it open to the public. So big shout out to First State Bank Community Bank. Again, I am sending out an email with links to watch this recording, to take a survey. It's going to have Ben's email address in it, so even if you forget it, you'll have it there. So thank you, everybody, for attending today.
Thanks, everybody.
Then they always fighting, breaking up,